wanted to do a mental session, having a little bit of a talk about trading volatility. Now, it's quite hard to just say, all right, trade it in a certain way, do this, do that. But more a case of things you want to be thinking about. What's significant? What's going to matter? So, we're seeing quite a lot of volatility coming in right at this minute. So, what's going to matter with volatility? Because it's very easy to get sucked in, and this is going to be the first thing, and I mentioned this on the morning stream, which I believe now should have been uploaded. There was a small issue with getting that uploaded. My apologies for that. So, volatility. I think these are the key things to me that really matter during periods of volatility. These key things revolve around, sorry, I'm just trying to see what's going on that's creating such a big, is the debt brake suspension, which is causing this big move that we're seeing at the moment in equities towards the upside further, and then particularly bonds towards the downside that we're seeing right at the moment. Right, onwards though, and expectations, big picture and time are your key things that are going to matter here. So, expectations, this is what matters, this is what catches people out. People are too quick, I find, or this is sort of a symptom that I feel people suffer from, is not managing the expectations of their trades particularly well. What I mean by this is you have a normal expectation or it's something that you're normally used to. So let's say you're taking a scalp trade in the S&P, maybe you're looking for around 3 handles, let's say. That's not a bad sort of reaction from level, little bit of movement. And you have a reasonable expectation, and that's going to take you a little bit of time to do. It's not going to happen immediately, it's not going to be super fast. So, all of a sudden, volatility's increased. Your 3-handle scalp now pays you almost instantly. And you're thinking, this is great. But what you've got to do is you've got to understand that everything's now changed. And it sounds easy, but it's very tempting when you're thinking, sell it here, take your 3 handles, and all of a sudden you've sold it there, it's gone 5, it's come back, it's gone 5 again. You're thinking, wow, 5-handle winner, I'll have that. That's way more than usual. Excellent. What you've got to do is you've got to think in terms of how far can this really go? At the moment, with increased volatility, 5 handles is not a scalp winner. 5 handles is the deviation that you get around a level. So you have a level, let's say this is your bigger picture move. There's your level. This move back to the level, let's say you sell the level. Decent place to sell. Let's assume that this is the previous low. Let's say you pull back here, you're looking for a move down here. Now, what your expectation should be here, and if this was a normal day, you'd sell this level and you'd look for this move, break the low. Now, at the moment, that could be 30 handles, which is way more than even the range of a normal day. So all of a sudden, you're then having to manage your expectations of normal and your expectations of what could happen here. Your expectation of normal is break from here, little bit of quick move down, you get out. But now it's a case of something you're used to, so sort of seeing 3 to 5 handle moves, things like that. All of a sudden it's doing your 3 to 5 handles here, just chopping around the level. You're in and you're seeing it go onside, back, onside, back, onside, back. That's exactly the kind of distance you'd be quite happy to take normally. But now, all of a sudden, this is the bit that you've got to sit through. And that's the key bit to it. Your expectation now should be down here, meaning that you've got to accept that what you're used to is now more something that you should just be looking for a chop around in. And therefore, once it breaks here, then the bigger moves on. And that's what you've got to do. You've got to be aware of what you can expect and be willing to hold on to those trades. Because when you get stopped out, and this is perhaps the easier way of thinking about it, when you get stopped out, you'll get stopped out for a 5-handle loser. So what you can't then do is give yourself 5 handles worth of risk, but only take a 5 handle profit on a trade. When ordinarily, you would probably be more inclined to say, if you're looking for say a 5 handle winner, you'd be looking maybe sort of 2 handles of risk. You're going to have quite well-defined, tight areas of risk. But then what you're doing instead is when volatility increases, is you're then going for 5 handles still, but you're risking so much more to get it. I'll show you a couple of examples of this on charts in terms of reactions that you get and in terms of your expectations on a trade and where to then be able to say to yourself, right, you need to now hold on to this. These moves are really sort of picking up a bit of pace, particularly in the bonds at the moment. Right, in helping that, big picture is going to be really, really important here. Now, what I mean by that is it's very, very easy when markets get fast to get yourself sucked into 1 minute time frames, to get yourself sucked into little bits of movement because, well, it gives so many opportunities. And I'm not saying don't use a short-term chart. I'm not saying don't take those opportunities, but maintain a bigger picture view. Getting your daily chart and using a daily chart is actually more useful at the moment than it might be on a normal day. You might not think that because it seems that the amount that's going on very short term is not going to be significant on a daily, but it is. The daily levels are really going to be key. We've seen this morning oil get below 49.58. As long as we stay below there, this has still got quite a bit of scope to fall. We've seen European equities down to significant daily levels and bounce. We've seen S&P similar as well. Recognising the daily levels is going to help you in managing your expectations. You break a significant daily level at the moment, let's say in the S&P. S&P the last 2 days has put in 200 handle plus moves. A break of a significant daily level could quite easily yield something like that again. That helps you manage expectations. That also allows you, when it does break the level, to look for a trade in that direction for that larger move. That also plays into how far can this go, and that's also where that big picture idea comes in. Give you the example in oil today, we're below 49.58. The next sort of key level on a daily is around about 46.25. So we've got possibly 300 ticks worth of move. Whether it's going to do that today is debatable, but with additional volatility coming into markets, there is scope and a realistic possibility of that kind of thing happening. The other element on a bigger picture as well is assessing whether a move is a reversal or a pullback. You're going to see a lot of moves now that will put in a huge change of direction. Take, for example, this morning in the Dax. The Dax broke a significant daily level, which was 12,500 approximately. This move dropped and came back in about 15 minutes, and that move was around about 150 ticks. 150 ticks last week was the entire range of the day on most days, and if not less than 150. Now, on the break of a level, the DAX has done that 150 ticks in one go in 15 minutes. So it's around about 6 minutes down and around about 8 minutes back up. Very, very fast movement. Big picture is going to help tell you whether this is actually a reversal or a pullback. Because at this point here, yes, it's a huge move, but that could just be a pullback before a further continuation. You've not got back beyond any point to believe this has to go up. And that again is where your big picture is going to help you out. Short-term perspective, it's really easy to look at that and think, wow, this market has changed direction, this market is going straight up. It's more the fact that it was such a rush down that it's given you so much space for a profit-taking move back up. So that's what I mean with the reversal. Looking at the S&P at the moment, we've seen a similar type move. And on an hourly point of view, we're holding above 31.17. So from an hourly point of view, I think I've got an hourly chart up here. I'll bring you an hourly chart in just a moment. For an hourly point of view, we're back up above 31.17. So let's bring you a chart in just here. Now, on the day, I think it's quite reasonable to say that we've possibly got a reversal on now. You've had a washout, we're back into this range, we could see a reversal back up to here, around those 58s. So on an hourly chart, that looks quite reasonable. This is not yet necessarily a full-fledged reversal though. Looking at a bigger time frame, there's those 58s. That's really where we need to get above before we can really be calling this a reversal. That's where we had highs, little washout going into December, and then the big rally begun. So until we get above 60, I would suggest that this is not actually a full-on reversal. It's possibly a pullback within a larger move. So that's the point on making sure you've got that bigger picture. Nothing wrong with playing this, and if you're playing it up on the day for a reversal, you could be looking all the way back up here. But bigger picture, this could still just be a pullback before a further continuation towards the downside. So don't lose track as to where the entire move is. My next and final point, so expectations, manage how far you think it can go, and I'll give you an example of this in a moment. Big picture, make sure you're thinking about the significance of levels that are being broken rather than just a very fast move through a short-term setup. Finally, time. You have a lot more time than you think in volatile markets. It seems not, because they're constantly moving. It constantly feels if you don't get in now, you're going to miss the next few ticks. But the main bit of the move is still going to move in a very similar way to normal. It's just more extreme in the way it moves backwards and forwards. So pullbacks are often deeper than expected, as I just alluded to with the Dax. But what's also then quite likely, and what happens a lot as well, is levels react quicker. What you've got to remember is there's a lot more people trading now than there were last week. Look at the S&P volume yesterday, that was the highest volume that we've seen in 2 years. So there's a lot more people trading. There's a lot more people with new positions. There's a lot more people who are emotional with their trading. Levels are much clearer when this happens because of the fact that people only have the reference points that were around or have been created during the day. So therefore, when you get a move down, a pullback to a previous low, often we'll get a reaction. Now, this is what I mean by time. This pullback could seem very, very deep and a long, long way. It would be very tempting to have sold it all the way up here each time it slightly stalls. When you get to the main level though, where anyone who is looking for a further short is looking at this thinking, where can I sell it? There. That's where you get the reaction. People are much more emotional and much more clear on where the levels are. So you can often find that risk is quite tight here. You will hit the level and move away. Once it moves away, this is where you'll then get the chop that is probably larger than a normal type trade that you would go for. And then you get the continuation and break of lows. That's the bit that's going to help you out. The reaction to levels quite quickly helps show you whether you're right or wrong. On a significant level, or not even massively significant, but a very obvious level, market reacts. It will either get you in and put you straight on side here, or it will get you in and stop you out. That's not a bad thing if it's going to stop you out, as long as you recognise and bring it back to expectation that it's probably going to do something like this before then rolling over and giving you a much larger move. I'll try and elaborate on this with a couple of charts for you. So, this is S&P. Excuse me. I'm trying to manage some of your expectations. This is a 5-minute chart. And what we've got here is the break below 32.20. So we'll look at the break of 32.20 and we'll look at the break of 31.81. So there's your levels, 20 and 81. So this is a daily chart. This is a 5 minute. Now, ordinarily, break of a level like this on a 5 minute chart, we've been sort of ranging sideways, you get a little bit of break, you could expect that maybe over the course of the rest of the day, we might do another 20 ticks to the downside. Maybe we'll get down to this little area down here, but it could take some time. So you're in a way slightly conditioned to think that, well, a bit of a break here and we're going to see a little bit of drift down slowly over time. In this instance, what you actually get is the break of 20 gives you a move all the way down to 31.95 in under 10 minutes. So very, very quick. Basically, the entirety of the move that you might be looking for over the rest of the day happens in under 10 minutes. So that's one of the things you got to expect, that once the move starts, it will play out quicker. Yes, this might not be absolute straight line, and it will have some pretty quick whips back within it that are going to make you a little bit uncomfortable. What you've got to be focusing on is where can this go, and not necessarily worrying about every little flick up and down within it. It will do that. It will flick up and down. You'll see break of 20, it'll go to maybe 10, whip up to 15, back to 10, whip up to 13, break 10, whip back a bit, and then keep on going, for example. Yes, that's uncomfortable, but you've got to maintain your expectation of where this can get to. Similar scenario on the break of 81. The first time we break, it goes to 76. This is where you could have been expecting a quick move and a continuation. And this is where once it goes through 81, it reaches 76, it stalls, it stalls, it stalls, back above 81, fine, you can come out of that. But you've got to maintain the expectation that on a break of 81, that's quite significant. Your next target that is down towards 60. And through 60, then a further continuation down, and you're looking more towards around about 31.20. So expectation-wise, that's now where you're going. Fails it the first time at 76. Next time, it's not managed to reverse this move. Next time through 81, then you get the next leg down, and it gets you all the way to 20. It gets you to 60 relatively quickly as well. Excuse me. That's what I mean about maintaining expectation. Once you're on side here, yes, each of these candles is not going to be a small candle on its own. They look small because the proportion of the move, or the scaling of the chart, but they're still going to be, some of those are going to be 8 handles wide, some of those 5 minute candles. So you're going to see a lot more movement up and down. If you maintain your view that it's going to 60 though, it still gets you there relatively quick. So maintain expectations of how far it can go. Also, now, whilst below 60, and significantly if we can get below 30.75, we've then got the moving average at 57, and you've got another level down at 34. That's your key area. 34 to 57 in the S&P at the minute. Get through there, this could turn into a much larger move. Go back, have a look on a daily chart of February 2018. I think that's the closest visual representation of what exactly is going on at the moment, or the most similar type movement. Last one, very quick on reactions. Just to give you an illustration of just how tight some of these things react. So what I've got here, and this is, think about people wanting to get into a trade. What we've got here is the morning's low in the DAX comes in at 12,869. We then break it very, very quick, just here. So once that level breaks, fast move to the downside. You get this quick shot down, a little bit of reversal. What you've got to be thinking here is, if anyone's looking for a pullback and they're not on a 1 minute chart, what's the level they're going to be looking at? Quite obviously, it's going to be 69. That also at the time was a single print fill as well. You had single prints from AB. You had single prints from down here, 23. sorry, C prints have gone lower than that. So yeah, sorry, you had single prints from 23, get into single prints fill at 69. So we can see where the single prints could fill. If you were long coming into this, nothing wrong with that, you can look for the move through single prints. But that's very clearly the point where people are going to be interested in selling this, and you get a very quick reaction. Hit 69, back straight off. This is a 1 minute chart. Hit 69, back straight off. As soon as you're back below 50, then market rolls over and makes a new low. And it does that in about 7 minutes, and that's a move from 69 down towards basically 69, 100 handles lower. You get a very quick reaction. And this is this is what I'm saying. When you have a lot more volatility, people have reference points that are all the same. Everyone can see the morning's low. Everyone who's looking for a short can see that that's possibly a place where you're going to get selling coming from. It's a fill of single prints as well. So as soon as you get there, if you get a reaction and get on side, that's where you should be feeling comfortable. Then you've got to say to yourself, okay, my expectations are if this is now a reaction from an hourly level, we're looking for a new low. Fortunately here, you get that new low very, very quickly. Once you've got it, you can get out of the trade. But reaction wise, this was a trade that gave you 2 ticks of risk. Now I'm not saying take the trade on, sell 69 and give yourself a 3 tick stop. What I'm saying is if you sell 69, you should go straight on side pretty quick. If this goes 69, 75 and starts trading higher, it's not paying attention to the level. You're going to know equally quickly that the trade's not working. Now, yes, that might seem like a big stop. It might be 10 ticks worth of stop that you take. But if you get it right, it's 100 ticks worth of profit. So the point is watch for those reactions. The reaction should come quick. Once it gets you on side, that's where you then need to manage those expectations. That once you get back down through these little reversal points, we're going for a new low. So a couple of things, hopefully you can bring that into your trading when there's more volatility. Make sure you are thinking about how far these moves can go. That's the biggest thing that catches people out, because if you go for small profits, you then end up taking little bits, and it's very easy to take big losses when there's much more volatility in a market. I'll wrap it up there, guys. Best of luck for the rest of the day. I'll catch you all at 4:45. We'll see how things have traded for the rest of the day, whether oil stayed below 49.58, whether the S&P current bounce has materialised into a larger reversal, or whether we can get back below 31.17 and continue this move towards the downside. I'll wrap it up there. I'll catch you all at 4:45.